Today on Inside the Issues, I speak with Domenico Lombardi and Samantha Saint-Amand on the subject of the spring ministerial meetings of the International Monetary Fund. Hello and welcome to this week's edition of Inside the Issues, a CG Online podcast. My name is Dr. Andrew Thompson. I'm an adjunct assistant professor of political science at the University of Waterloo and program officer at the Balsey School of International Affairs. Every week on the program, we're joined by an expert or experts in global governance, international public policy, or some other aspect of global affairs. Today, we're joined by Domenico Lombardi, who is the director of the Global Economy Program here at the Center for National Governance Innovation, and Samantha Saint-Amand, who is a research associate, also with the Global Economy Program here at CG. Welcome to the program.
Thank you.
Thank you.
So the IMF has just had its spring ministerial meetings. For our audience, can you just give us a little bit of background on these meetings? What is the purpose of the meeting, who attends, etc.?
So the IMF ministerial meetings take place twice a year, typically in April and October. And the feature is that finance ministers from all over the world come to Washington to discuss the status of the global economy. And in doing so, they clearly highlight their economic strategies, economic plans, but most importantly, this is a way to spur a better understanding of other countries' policy constraints and how especially policies set forward, implemented by other countries could spill over to their own economies. And this is, after all, what international cooperation is about. Clearly over the years, the IMF ministerial meetings have become increasingly more important because of increasing globalization of the world economy, and also because the G20 and the G7, for what matters, happen to meet at the margins of the IMF ministerial meetings. Clearly, at each of those meetings, there is always one or two issues that really drive the conversations, whether in formal meetings or in informal meetings.
Right. And the reports that have come out of this last set of meetings, the IMF has been cautiously optimistic about recovery of the global economy. Why did it come to this conclusion?
They're optimistic mostly because we're finally seeing a stronger recovery in advanced economies.
Okay.
So they're mostly optimistic about the US, the UK, and Germany. Credit conditions are improving, unemployment rates are falling, and even in the Eurozone, although there's still low growth, they're actually emerging from their double-dip recession. Every Eurozone economy is projected to have positive growth this year, with the exception of Cyprus. So there is reason for optimism, but as Christine Lagarde said in a recent speech, it's too weak for comfort. So the risks are still on the downside.
So I would say the overall thrust of that the IMF has conveyed to these meetings is that, as Sam has just pointed out, that the global recovery is underway, is gaining steam, especially in some economies. However, while some old risks have sort of receded, some new risks are emerging. And I would say this is really the first time where we see a picture whereby emerging economies are slowing down, contributing less to global economic growth since the height of the international financial crisis. And we're seeing growth in some advanced economies that is picking up at a reasonable speed and thereby enabling those economies to contribute more to global economic growth. On the other hand, in the Eurozone, we see that, yes, growth is picking up also there. Certainly it is in a better shape than it used to be until, I would say, a year ago or so.
Right.
But even in the Eurozone, we see some new risks emerging. We see that the focus of attention is now shifting from the sovereign debt crisis to very low inflation or lowflation, as Christine Lagarde has dubbed it, and clearly, also posing some potential risks for deflation should the Eurozone economy be hit by some adverse shocks in the coming months or years.
And perhaps just to build on that point, do you think that the prospects of low inflation, particularly in Europe, are very real? I mean, and what would be the consequences essentially if this comes true?
What we see is that inflation is generally low in all the major advanced economies. Is low in the United States, is low in Japan, of course, and is low in the Eurozone. However, while in the United States and in Japan, inflation seems to be gradually picking up, underlying data is showing us that inflation is slowly trending upwards. In the Eurozone, this picture is not so clear-cut. And this poses two concerns. In the first place, we see that the debt dynamics of especially the southern economies is worsening, maybe worsening, because clearly they are already in a situation of low growth. If we add a situation of low inflation, the combination of the two factors is essentially to worsen debt dynamics. And then the second concern is that these southern economies of the Eurozone have to catch up in terms of competitiveness vis-à-vis the northern economies of the Eurozone, and this catch-up process is much more painful if it is done in a context of very low inflation.
Great. Thank you very much. For the next section, I would like to pick up on what's happening in Europe. We will be back in a moment with Domenico Lombardi and Samantha Saint-Amand. You are watching or listening to Inside the Issues, a CG Online podcast. Look for us online at cgonline.org, on Facebook, on YouTube, and on Twitter. Welcome back to the program. Samantha, the IMF has noted that there has been a number of countries in Europe that had been struggling the last few years have started to rebound. Does this suggest that the austerity measures of the last few years that have been imposed on countries like Spain and Portugal and Italy have actually been effective?
I wouldn't go that far. I think initially the austerity measures were good for as a signaling mechanism to markets, and I think the channel through which they helped debt dynamics is through the credit rating agencies. So it signaled to the credit rating agencies that they are planning on consolidating their books, and the credit ratings responded to that, gave positive outlooks or upgraded them, or at least didn't downgrade them. But overall, I don't think that austerity measures were good for these economies. I think that the impact that they had on growth and inflation prospects as well had more detrimental effects on debt dynamics and on the economies, on the unemployment rate, than the austerity measures had. And we actually did some simulations and we found that the recessions that these economies suffered had a more negative impact on debt dynamics than decreasing the primary deficit, so going into primary surplus for some countries.
If we take the case of Italy, its debt to GDP ratio worsened by 12, 13 percentage points from 2011 to 2013. It was 120 at the end of 2011. 2 years later, it was 132 or 33%. And actually, we have estimated that roughly half of that increase is accounted for by GDP contraction.
Right.
And this GDP contraction, of course, was driven to a large extent by the aggressive fiscal consolidation. So it's not just a matter of fiscal consolidation per se. It's a matter about how this fiscal consolidation was conceived, was implemented, was not growth friendly to start with. In many of these countries, fiscal consolidation was essentially implemented in terms of tax increases, rather than cutting on unproductive expenditures. And very little was done in terms of structural reforms to really enhance the growth rate. And therefore, what we have seen is that, yes, deficits have been reined in. Again, if you take the case of Italy, the budget in structural terms, that is taking into account the economic cycle, is very close to balance. However, the debt to GDP ratio has been worsening substantially. And this is because at the margin, the benefits from fiscal consolidation have not been enough to compensate for the depressive effect on growth that fiscal consolidation has generated. Clearly now we are in a slowly changing situation insofar as the pace of fiscal consolidation is slowing down. Right. This is why the impact on growth is muted. And also at the same time there is the expectation that a new round of structural reforms will be implemented. And if indeed this round of structural reforms does take place, this could act on the denominator of the debt to GDP ratio, thereby enhancing growth, and by doing so helping to stabilize the debt dynamics.
Right. And if we could perhaps shift focus to the US, the IMF was also, I think, quite cautiously optimistic about growth in the US. How do we account for that, and what are the wider implications for the world economy?
Well, in the US, it's the pickup is driven by consumer or private demand. Right. We've seen the unemployment rating falling quite a bit in the US, which we don't see in the Eurozone. So there's a lot of private domestic demand, inventory demand, credit conditions are improving in the US, a lot of conditions that we're not seeing improve in the Eurozone. In terms of the wider implications, I mean, the US is the largest economy in the world, so it has huge implications for trade flows and could spur a recovery in the Eurozone. It could help emerging market economies through their slowing growth.
What we see is that the economic recovery in the US has been solidifying a lot. In sense, it's not just the quantity, the rate of growth, which is decent by its own standards, but it is also the quality of the growth that we're observing in the United States, because essentially this growth is being driven by increased resilience and strengthening of private sector demand. So it's not so much about the public sector. If anything, the public sector contributed, to increased uncertainty towards the end of last year. Sure. Due to the government shutdown. But what we see is that private sector demand is solidifying, is contributing positively to economic growth. And clearly the US, still being the largest economy, this has significant spillovers for the rest of the world economy. Therefore, really the concern is at this stage among the advanced economies, more in the Eurozone than in the United States. And of course, the emerging economies pose some additional concern in terms of their slowdown we are currently observing.
Great. Well, thank you very much. And perhaps for the next section of the program, we can focus on some of the changes that are taking place in the emerging and developing economies. We will be back in a moment with Domenico Lombardi and Samantha Saint-Amand. You are watching or listening to Inside the Issues, a CG Online podcast. Look for us online at cgonline.org, on Facebook, on YouTube, and on Twitter. Welcome back to the program. Domenico, the IMF also reported that growth in the emerging markets and developing economies has slowed. What led them to that conclusion?
What we see is that the rate of growth we have been observing since the height of the international financial crisis that has enabled emerging economies to essentially shape the global economy growth patterns, especially since the height of the crisis, well, that growth is slowing down. And clearly, all the eyes are on the largest emerging economies. China is still projected to grow at a rate of 7.5% this year, which is, roughly speaking, the target that the Chinese authorities consider to be feasible and satisfactory from their own viewpoint. Clearly, the biggest question mark is how the world economy would cope if China were to significantly slow down. And this is certainly a scenario whose implications right now have not been fully spelled out, especially because the degree of interconnectedness, the increasing globalization of the Chinese economy over the latest years has been pretty remarkable, and so would any possible fallout of the same economy.
Sure. Smith?
Sure. I mean, emerging market economies during the crisis represented about 86% of global growth, and now this year they're projecting that they'll represent about 70% of global growth. So just on world trade flows and global growth in general, emerging market economies have a huge impact. They represent most of the thrust. The pickup in advanced economies has interesting implications for emerging market economies. On the one hand, we might approach the process of monetary policy normalization, and that's having huge implications for emerging market economies through volatile financial flows. So the process of tapering U.S. Quantitative easing and eventually tightening its monetary policy has problems or creates volatile capital flows in emerging market economies. At the same time, the increase in domestic demand in the U.S. is helping emerging market economies because it is it's demanding their exports. So we're not quite sure how this is going to play out. Emerging market economies are doing their best to improve what's called their economic fundamentals to try to safeguard against possible volatility. But there's still a risk that this could have huge implications.
And just on that point, the IMF did note that in many of these emerging markets and developing economies, there are weak economic fundamentals despite significant growth rates in the past. What specifically were they referring to?
I think they're mostly referring to exchange rate mechanisms, and they think that they need to open their exchange rates so that they can more easily absorb shocks. But what is your view on that?
Certainly the increased volatility that we have been witnessing in the latest few months in emerging economies highlights one fundamental tension in the governance of today's world economy. And it is, on the one hand, we have a world economy that has become increasingly globalized with significant spillovers from the policies of one country to the other, and yet the decision-making mechanisms of those same policies are located at the national level. And therefore, whenever the US Federal Reserve, for instance, decides to fine-tune or to change its own policy stance, of course it does that on the basis of the implications for the US economy, because this is perfectly consistent with its own mandate.
Sure.
And yet, given the systemic relevance of the US economy and the US financial markets, this has significant spillovers to the rest of the world economy. And of course, we have seen quite a glimpse of that in the latest few months. There is no clear-cut solution to that. The answer is more cooperation, increased cooperation. But we have seen that both the IMF and the G20 have not been effective at managing the coordination, the management of these spillover issues. And therefore, the second best solution, in a way, is for emerging economies to improve on their own fundamentals, to increase flexibility of their exchange rates, but also to strengthen their macroprudential frameworks and the supervision of their respective financial sectors, so as to contain as much as possible the negative spillovers coming from decisions of systemic central banks.
So at these ministerial meetings, Do countries get nationalistic, given that a lot of the decisions that are being made are happening at the national level, and does this play out at the meetings?
No, not really, because the way these meetings take place is exactly to avoid any confrontation. And therefore, what we see is that typically the most controversial issues are typically excluded from the agenda or are not part of the statements that the ministers would be making. Clearly, there are exceptions to that at the height of the international financial crisis, when the common aim was to rein in what could have triggered a meltdown of the global financial system. We did see a lot of sort of genuine proactive cooperation that allowed to take very important common actions. But at this stage, the tendency is really to relegate confrontational issues to the sidelines. Certainly there are conversations happening at the margins of the formal meetings.
Right.
And this is where I would say, the most important discussion on those items would be taking place.
Right. Thank you very much. I do want to pick up on the question of the governance implications in the last section. We'll be back in a moment with Domenico Lombardi and Samantha Saint-Amand. You are watching or listening to Inside the Issues, the CG Online podcast. Look for us online at cgonline.org, on Facebook, on YouTube, and on Twitter. Welcome back. Domenico and Samantha, for the last section, I'd like to talk about the governance implications of these meetings and for the IMF more broadly. How are countries reacting to these reports?
The reports that the IMF put forward at the ministerial meetings are essentially staff reports. In other words, they do not commit the executive board, they do not commit the IMF membership. And this allows, on the one hand, the staff to be more candid than it would otherwise be the case. But on the other hand, it also tells you that there is relatively little political action that is being taken on the basis of those reports. So while those reports are, of course, they form the basis for the ministerial discussion, at the same time, what we usually observe is that it is very difficult that we see any coordinated action that is taken on the basis of the IMF analysis, with some relevant exceptions, clearly one being at the height of the international financial crisis, right, where the incentives to act were, of course, substantial. But that said, one shouldn't conclude that those meetings are not helpful. Quite the contrary. In fact, they enable finance ministers and central bank governors to appreciate in a much more nuanced way the constraints that other countries have in their own policy making decisions. They also help to form a shared consensus on where the global economy is moving. That said,
The reports definitely inform domestic policy, but there are other sources of information for domestic policy. For example, there have been competing recommendations on what to do about monetary policy between the IMF, who says that advanced economies should keep it accommodative, and the BIS, who says that we should seriously be considering the process of normalization. So while the IMF is informing domestic policy, there are other things to consider and
broadly, I mean, IMF reform has been incredibly difficult to achieve, even with the G20 consensus coming out of the Seoul meeting. Could you say a little bit about the opposition the IMF encounters in trying to reform itself?
Clearly, any IMF reform has to be approved by the membership. And still, in the follow-up to the crisis in Seoul in 2010, G20 leaders endorsed an important package of IMF governance reforms. According to this governance reform, China would become the number 3 shareholder of the IMF. All the BRICS would be among the top 10 shareholders. And there would be provisions to simplify executive board representation, especially enabling the Europeans to mainstream their current over-representation on the executive board of the IMF, the main policy-making body. That said, this package has not come into effect because the US Congress has failed to ratify the related legislation that the Obama administration presented before Congress twice in the latest few months. And as a result of that, this reform is on standstill, but it is also jeopardizing the dialogue in the G20 context, and therefore the implications of lack of ratification of this IMF reform, they go beyond the IMF itself. Clearly, the G20 was elevated at the leaders' level. It was to become the main economic cooperation forum upon the assumption that advanced economies would provide more voice to emerging economies, while the latter would take more responsibilities on their own shoulders. Now, clearly, this implicit contract has not been fulfilled so far. And clearly, this is undermining the effectiveness of the dialogue, not just within the IMF membership, but also within the G20 itself.
And is it also affecting the ability of the IMF to respond to economic crisis?
In a way, it does, because clearly the IMF war chest is limited. Has not grown as much as it should have, and lack of ratification of the Seoul Agreement, of course, does not enable the IMF to increase its war chest. Essentially, now it is still forced to rely on contingent lending agreements, which may not necessarily be renewed. But on top of that, I would say the most important implication is not just financial, but is really, in terms of undermining the cooperative spirit within the IMF, because we are seeing increasing fragmentation or segmentation between emerging economies and advanced economies, something that the crisis had helped to rein in, to fill to a large extent.
Right. And if some of the problems that have been identified, such as low inflation or weak fundamentals, if these continue to become problems, do we have the tools to rectify them? Is there enough global cooperation to intervene in a positive way?
At this stage, what we see is that essentially low inflation is something that central banks are going to have the first shot at. In the case of the Eurozone, the ECB has still plenty of room to leverage on. The ECB has been much less aggressive than the US Fed has, and therefore there is certainly much more scope for the ECB to act. But that said, there is certainly an issue of international cooperation if we were to see, slow demand or slack in demand in the global economy. And the problem is, however, that at this stage there is no consensus in terms of how you're going to address that.
Great. Thank you both so much. This has been wonderful having you on your show. It's been absolutely fascinating, and best of luck with the rest of your research.
Thank you.
Thank you.
And thank you to our audience for joining us. You've been watching or listening to Inside the Issues, a CG Online podcast. Look for us online at cgonline.org, on Facebook, on YouTube, and on Twitter.